In our last monthly investment guide, we had increased our overall equities exposure in our asset allocation strategy to overweight. And this has been the right call. Global equities have by now rallied over 25% from their bottom in late March. We believe the timing of this relief rally is warranted, as policymakers have begun to effectively curtail liquidity-driven risk of a larger financial blow-up. The magnitude of this rally, however, deserves scrutiny. With the sharp bounce, much of recent positive developments have been priced in, but one needs to ask if the downside risks are fully discounted. Although specific asset classes such as treasuries and US credit continue to be supported by policymakers, the outlook for often asset classes such as equities is less clear. Incoming corporate results and economic data suggest that the situation will get worse before improving. Importantly, the risk of subsequent waves of infection warrants caution. Despite being ahead in terms of controlling the pandemic, China's experience demonstrates that the path towards normality will be long drawn out. China's economic activity remains below average, even in the domestic service sectors, which have been less affected by weak export demand. In the absence of a vaccine, we believe that the process of exiting containment measures globally is fraught with uncertainties, and the risk of a more drawn-out recession, which is worse than consensus expectations today, should be taken into account. This month, we moved to pare down our overall exposure to equities from overweight to neutral. As the situation evolves ahead, we would be keen to add exposure if valuations turn more attractive or if risk factors abate meaningfully. We remain overweight in emerging market high-yield bonds. For more information, please read the latest edition of our monthly investment guide titled The Long Path to Normal.